Futures down again today. Third day in a row of losses. Could be 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Fed Governor Stephen Miran sounds the alarm on U.S. vulnerability, but fresh data points to resilient economic growth.
And a bid for a comeback. Intel seeks an investment from Apple as the two discuss how to work more closely together.
And Starbucks is closing stores and cutting jobs while the White House orders federal agencies to prepare for mass firings.
It's a weird thing because those headlines would imply that it is a weak jobs market, but we just had jobless data. And it was really good.
Yeah, there's so many up and down stories. Myron's worried about the economy.
Yeah.
It's growing at 3.8%.
Yeah.
Prepare for mass firings. Jobless claims drop.
This is a choose-your-own-adventure market, and Starbucks is part of that adventure. As we were talking about, it's one of the stocks we're watching, even though it's not moving that much. As a matter of fact, it's basically unchanged. Matt, it says that it's going to close several stores. It's going to be cutting 900 jobs. It's part of a $1 billion restructuring plan. Overall store count, they say, is going to drop by 1% during its 2025 fiscal year.
All right, only a drop of 1%, so maybe they could cut a little deeper. Intel was up as much as 3% this morning after Bloomberg reported it approached Apple about securing an investment that follows the $5 billion investment from NVIDIA and the 10% stake from the U.S. government. Maybe, just maybe, this is going to perk up Intel's foundry business a little bit.
Just maybe. That's certainly the hope, and let's broaden out and ask that question on the conversation on Intel. Joining us is Bloomberg Tech co-host Caroline Hyde. And Caroline, there's been a lot of skepticism thrown out there, and maybe that's why you're starting to see the stock come in. Bernstein, for their part, said that they have a capability issue, not a money issue. So what would an investment from Apple help Intel do?
I think, once again, just a sign of support and maybe future end demand for the fabrication of chips. All along, we have worried about the ability for them to keep up with the innovations that are necessary to produce the most sophisticated chips out there. And that's why Lip Bhutan, the relatively new CEO in the previous earnings, had said, I'm putting this fabrication stuff on ice. Pat Gelsinger's idea that Ohio was going to become one of the biggest producers of manufacturing of chips in the world ever.
Great state of Ohio.
Great state of Ohio. Go Ohio. But, I mean, it was put on ice because they were like, this is too complex at the moment, and I can build it, but I don't know if they're going to come. Well, maybe this is a signal that they're going to come. Apple doesn't use Intel to make its chips. It designs its own in-house, then it leans on TSMC. NVIDIA does the same. NVIDIA designs chips, and most of them are made by TSMC. But NVIDIA put in money. Now, if you can persuade Apple that strategically they could work better together, this would really help Tim Cook with that $600 billion deployment that he's promised into US in terms of domestic manufacturing and AI focus on servers, training. But that's a lot of money to put to work. It would be nice if you could help back Intel. Intel added $8 billion in market cap yesterday on the back of this.
Yeah, I mean, it could really help Donald Trump, right? Because
Yes.
remember, he got this 10% stake, and then he somehow convinced NVIDIA to buy a $5 billion stake. Maybe Apple wants to take a stake. It could be good for their business, right? It could be good for them if they start doing more business with Intel, and I'm sure that's part of the calculus. I want to ask about, speaking of calculus, quantum computing, because it seemed like there was no real use case for it yet, but HSBC says it can help them price bonds 35% better than they could have previously, or predicts bond prices.
And real tangible data there. They're saying, look, this wasn't an out in the wild actually pricing in the real market, but running as if it would. And they got so much more efficient pricing. Everyone's going to run to catch up with this. It's interesting that, of course, IBM is rising pre-market on the back of this. This is the provider of quantum. It's Quantinuum who helped JP Morgan make a breakthrough previously when it came to quantum computing and the ability to find really certified, truly random numbers. That's helpful in cryptography. It's helpful in just understanding that transactions has actually helped and gone forward. But we're seeing basically a race going on. IBM has already put its stake in the ground. We will have a fit-for-purpose quantum computer in 2029. They're already in the wild with plenty of people experimenting, and HSBC is one of the key clients that have shown that this is really working in some way to make their business more efficient. But in the same way that AI has set off this firestorm in the financial services, everyone's racing to use it within their own quant strategies and be able to make more efficient in terms of pricing data, so too Quantum is the next iteration. It's using in parallel an ability to solve so many problems simultaneously. This is just going to make the world of AI supersonic.
By the way, we just showed a 5-year chart of IBM. That's just the price
record
change.
high, yeah.
If you adjust for dividends reinvested, so total return analysis, they have tripled, up 192%. They have far outperformed Amazon on a 5-year basis, and they have even outperformed Microsoft on a 5-year basis. So they're neck and neck right now with Meta. They're doing just as well as a lot of these hyperscalers, and that was pretty surprising to me. Carolyn Hyde co-anchors Bloomberg Tech with Ed Ludlow. You can catch her program starting at 11 a.m. They're going to talk, obviously, a lot about quantum computing, as well as Intel and Apple, I imagine. We mentioned Starbucks approving a restructuring plan that includes job cuts and store closures. Let's talk about that with Bloomberg's Shelley Banjo. She's our managing editor for Global Business. And Shelley, this is Brian Nichols' second round of job cuts since he took over a little over a year ago. Since then, Starbucks shares are down 6%. So, is he going to finally do something to make these moves in the right direction?
I think that's what investors are hoping. We saw the shares pretty much flat on this news, and you might be wondering why. I think it's about, could they have gone a little bit deeper? But in general, people, I think, want to see him right-size this store fleet. They want to see him get this stuff right, get rid of the stores that are not performing, that haven't performed in a very long time, and start reinvesting that money into refurbishing. They said they're going to refurbish about 1,000 other stores and then start building again come next year.
But he already made all these splashy announcements, things like, we can refill milk on our own, which I guess is super appealing, that they're going to cut the menu down and not have as many crazy orders for baristas to do. Is this a sign that that turnaround so far hasn't taken hold, that those measures haven't yet helped?
I think a lot of that is aesthetics at the front. Let me put some splashy announcements so that people start coming back into our stores. They start pouring their milk again. And that was actually a thing people really, really wanted, and it seems to have made a difference. Then it comes the hard part, right? We got to close actual stores. We got to fire actual people, pay those restructuring costs. This one in particular is $1 billion of restructuring costs. That takes time. That doesn't really tend to resonate with customers. In fact, it's bad press often when, you shut a store down and people lose their jobs. And so a lot of this is the hard part, but is impeccable and important to get this company, operating as it should be.
I want to finally ask you about CarMax. I know it's very different business than Starbucks, but you cover
we do it all. We do it all here at
global business,
Bloomberg.
and you sit next to Rick Clough, who's our transport, our autos team leader here in the Americas. I thought that people were going to be buying more used cars because, new cars are so expensive and people are trying to save money, and yet they missed on the top and bottom line at CarMax.
You're not wrong. People are buying more used cars, but this is an instance where you saw a lot of pull forward because of the tariffs. You saw a big frenzy of buying back in April after the Liberation Day and the tariff announcements. And so we're lapping some of those things. And also, as a lot of people, went into new cars, some of the used car business fell down a little bit.
Yeah, shares getting smashed this morning, down 16%, adding to a 30% year-to-date decline. Shelley, thank you so much for joining. That is Bloomberg's Shelley Banjo. Now, all of those things would seem to suggest that this is an economy in trouble. Not so, according to the economic data released in the last hour. It showed the U.S. economy growing at the fastest pace in nearly 2 years, thanks to consumer spending, though apparently not on used cars. Fed Governor Stephen Miran spoke to Bloomberg ahead of that data on the next steps for the Fed.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
I wonder if you would still call it as restrictive with this latest batch of data in hand. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, can we talk about the data? Jobless claims, GDP, what did it show?
Basically, it shows it's a tough day for the Trump administration because on the one hand, they want you to believe that the interest rate should be cut significantly. But the data are telling a totally different story, one that the administration could embrace, because, as you mentioned, we get strong GDP growth and we have this odd situation that the Fed's been talking about, low hiring but low firing, with jobless claims falling to 218,000. Durable goods orders were up 2.9%. And as part of GDP, the increase in GDP, we saw an increase in business spending overall. Now, durable goods is interesting. You're talking about Intel, but computers and computer chip orders were down during the month. Even though we saw a big increase in durables, it was mostly airplanes. The trade good balance shows the effect of tariffs, $85.5 billion, because imports fell by a huge amount, over 4% in July, after rising significantly because basically we saw people pulling forward expenses. As you mentioned, GDP up 3.8%, revised up from 3.3%. Consumer spending pushing that higher, business spending pushing that higher. So where do we go from here? Well, we know where Governor Miran is, and now we're beginning to see where more members of the Fed are. We have a lot of Fed speak today, and the first three have been out. You heard from Miran, Austin Goolsbee a few minutes ago saying he's not sure they should front load rate cuts given where the economy is. And Jeff Schmidt, who is perhaps the most hawkish of all the Fed governors, just out with a speech this morning saying that inflation's too high. The labor market, though cooling, still remains largely in balance, and he views the current stance of policy as only slightly restrictive, which I think is the right place to be. So he's not calling for rate cuts either. Mr. Miran, I think, is on his own island at this point.
All right, Mike, thanks very much. Michael McKee there in Washington, D.C. Let's get a quick check on futures. Just about 20 minutes to go until the start of trading. Looking at red arrows across the board. S&P futures down about 0.5%. NASDAQ futures off even more, 0.75%. And Russell futures down by more than 1%. So we have some pretty significant declines in futures after what has already been a couple days in a row of losses.
Yeah, and that is also being fueled by what we're seeing in this bond market. Yields are higher across the board. The 2-year yield goes up by 3 basis points, 10-year also 3 basis points. We are trading at around the highest in about 3 weeks. So that causing the pain, especially in the small cap index that you pointed out.
Yeah, absolutely. They need those rate cuts that Miran is pushing for, because a lot of the small caps
are unprofitable.
Don't make any money
Correct.
at all. Coming up, the U.S. lowers tariffs on auto imports from the EU, not to a level that you may not have expected, but to the level that they had already promised, and prepares for levies on medical devices. Your trade roundup next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. Former French President Nicolas Sarkozy has been sentenced to 5 years in jail for criminal conspiracy after judges found his 2007 campaign was secretly bankrolled by Gaddafi's regime. Sarkozy, who denies wrongdoing, was cleared of more serious corruption charges, but must begin serving his term within a month. The White House Budget Office is ordering federal agencies to draft plans for mass firings if Congress doesn't fund the government by October 1st. That's a sharp break from past shutdowns when most non-essential workers were only furloughed and later paid back. Democrats call it intimidation, and Senate Minority Leader Chuck Schumer is warning the move will end up reversed in court. And Jimmy Kimmel's late night return earlier this week pulled in 6.3 million viewers. That's the biggest audience ever in his regular slot, quadruple this year's average, despite the fact that Sinclair and Nexstar stations didn't air the show in major markets. The spike follows Kimmel's suspension over remarks about conservative activist Charlie Kirk. His opening monologue has racked up over 26 million views online. Joe Matthew yesterday was talking a lot on Balance of Power about the fact that they couldn't see it in Washington. And I wanted to call up Joe and tell him about this thing called streaming or YouTube. You don't have to have cable to watch it. You can just have Disney Plus.
Does Disney get the same amount of revenue, though, if you're just watching a video on YouTube? Probably not, right?
I don't think so. But the point is, you don't need the normal linear television setup. You don't need bunny ears to watch ABC, NBC, and CBS. They all have streaming content that you could watch anywhere, whether or not Sinclair decides to broadcast in your region.
Which is like kind of bad for Sinclair and Nexstar, for people to be like, we don't need you. We can just go look at this stuff online.
Apparently not everyone's figured it out yet, but a lot of people have figured it out.
That they have, and a lot of people clearly watched on cable too, of those that could. Elsewhere, Matt, there are a number of developments on the trade front. The U.S. has officially lowered tariffs on European Union auto imports to 15%, a win for the bloc. Meanwhile, the Trump administration launched investigations into imports of robotics, industrial machinery, and medical devices. Let's discuss with Bloomberg's global trade czar, Brendan Murray. Brendan, a reminder that none of this is settled. Let's start with the 15% tariff on autos from the EU. It's something that the bloc had wanted. They'd wanted relief. How big of a win is this for them?
Yeah, exactly. It's not exactly a win if you pay 15% more for your exports to go to another country, but it's a relief because the previous level was 27.5%. So this is something that European automakers have been waiting 2 months for. It's backdated to August 1st, so there's a sense that that they can deal with 15%. It's not exactly a best case scenario, but it's something they can absorb and we'll just have to deal with. The big question now between the U.S. and the EU is, can they address the 50% steel and aluminum tariffs? Those sky-high rates are hurting the exports of European steel and aluminum to the U.S. They're the largest suppliers to the U.S. market, so that's a big issue that still needs to be addressed. They're going to try to work out some sort of quota arrangement where some quantity could be imported into the U.S. At low or zero tariffs, but that's still an issue that needs to be worked out. It's going to be a thorny one because the Trump administration really wants to put a tariff wall around their steel and aluminum industries.
Well, and this is a benefit in a couple of ways for European, Japanese, and South Korean automakers, Brendan, in that they have certainty, first off, but also, that 15% tariff doesn't look so bad if you're looking at Ford, Tesla, and GM that are paying those 50% tariffs on steel, 50% on aluminum, 25% on components made overseas, like 80% on anything you get out of China, which is a lot of stuff. So, Ford says, for instance, the cars that they make, when they go head-to-head with cars out of Japan or South Korea, are still far more expensive, like $10,000 more compared to $5,000 for those that only have to pay a 15% flat tax.
Yeah, exactly. I mean, I think what you're describing there is just the complexity of this tariff policy that the Trump administration is rolling out. For every industry that you help, that you protect, you hit another one over the head. And this is just going to continue to happen. We now have 12 sectoral investigations ongoing, which could lead to tariffs, these so-called 232 cases. These are the ones that are coming on pharmaceuticals and chips and critical minerals. We just got word yesterday about the robotics and the medical equipment are subject to these investigations now. So this is Plan B if the administration loses the Supreme Court case on these broader country-by-country reciprocal tariffs, that they can hit these industries pretty hard and with a legally solid authority to use these tariffs. But when you start mixing them all together, it gets very complicated to pick winners and losers. Eventually, you just create this massive bureaucracy that hurts a lot of companies.
Yeah, it really has a feeling of one step forward, 2 steps back. Brendan, thank you so much for joining us on that. That is Bloomberg's Brendan Murray. And speaking of cars, we talk the ultimate car. It is McLaren Racing's team, which is now valued at over $4 billion in its latest stake sale. We're going to speak to the CEO, Zak Brown, a conversation that we are excited for. Will Piastri win the Drivers' Championship? Will they finally get the Constructors' win? That looks to be on the docket in their next race. All of that, stay with us. This is Bloomberg Open Interest. Stocks may not be in bubble territory. That is according to strategists at Bank of America. The team led by Savita Subramanian told clients that, quote, the S&P 500 index has changed significantly from the 80s, 90s, and 2000s. Perhaps we should anchor to today's multiples as the new normal rather than expecting mean reversion to a bygone era. That is a stark difference from many on Wall Street who have compared AI stocks to the dot-com bubble. Joining us now, Around the desk is Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Sarah, this time is different. We always say it every time we think times are different, and then it's not. But the thing is that if this is a bubble, it can run a whole lot longer before something bursts. Just how are you thinking about this environment and the huge run-up we've had specifically in AI-related stocks?
Well, not to date myself, but I was around for for some of the changes that happened in those marketplaces. And the parallel between now and the dot-com bubble, for me, is a little bit disingenuous, only because at that point in time, you were seeing a lot of customers being financed by their vendors. So a lot of the sales, now this is the argument.
You mean like
Nvidia, I was going to say that.
And I was just about to say, and now we have a round robin of one, but it is one where the cash actually exists. This isn't something where people are giving you credit for buying something because you want the sale. There's actually a lot of cash being generated by these companies, so that the customers have the cash to do it. The question will be when that spending uptake starts to slow down, because even if you don't stop spending, any acceleration that decelerates, markets don't like that, investors don't like that, and that's where you start to see cracks in the margin, and that's where you keep seeing these little moments in the tech sector where the stocks have a problem because people are starting to worry about that cadence of spending.
But are we really going to see a return on these investments? I mean, so far, I haven't seen many practical use cases. HSBC was pretty cool today with their bond pricing.
So that's the other.
It's not even AI. That's quantum.
That's
computing.
Quantum computing, and that's the other issue. But if you think also about all that money that was spent on dark fiber, how long did it take to get absorbed? But then you started to have fiber shortages again. So I don't know what the answer is in the near term, but I think from right now, people are much more worried, as I think Facebook put it, than of underspending than overspending.
All right, we're going to keep you here with us because we have a lot more to talk about than just this, one question. Although I think it's pretty fair to say that's been a huge market driver. Sarah Hunt staying with us. Check on futures as we head to the opening bell. We're down for a third session in a row. If we open this way, and it looks like, of course, we will, because there are only 4 minutes to go. Down 0.5% on S&P futures, down 0.2% on NASDAQ futures, and the Russell down more than 1%. We'll be right back with your market open. This is Bloomberg. We are moments away from the start of trading. I'm Matt Miller. This is Bloomberg Open Interest, looking at a real drop in futures here, 0.5% on S&P futures. We're down 2/3 on NASDAQ futures, and Russell 2000, the small cap futures, down more than 1% because, at least in part, we have really strong economic data out, and that doesn't bode well for the Stephen Miran camp. Why would we need, 100, 150 basis points of rate cuts by the end of the year if the economy is growing at 3.8% and jobless claims are coming in at a low? Ringing the bell at the New York Stock Exchange, you've got Lee Jae-myung, His Excellency Lee Jae-myung, the president of South Korea, to celebrate the 80th anniversary of the UN at the UN General Assembly. I'm sure he was just electrified by President Trump's speech the other day. Down at the NASDAQ, you've got Kodiak, which is, I'm going to say it's like some kind of AI autonomous vehicle SPAC. In any case, I'm sure we'll hear much more about that in the months and years to come. Dani, what stocks are you watching?
I am watching Starbucks this morning, Matt. Sure, it's not the biggest mover, but it is noteworthy what they're doing. They're down just about 0.3%, and they say that they're going to be closing several stores. They're also going to be cutting 900 jobs. All of this is part of a $1 billion restructuring plan. Overall store count for them, that drops by 1% during its 2025 fiscal year. And that also comes off the back of all the changes they've tried to make, like you can pour your own milk now. They tried to put things like boba in the stores and cut down on the complexity of drinks. But I guess those are all just cute things, and you actually need to start firing people and closing stores to make change.
I mean, they have over 18,000 stores, and the ones that I've been in aren't so impressive. So maybe, just maybe.
You can't sit in them anymore. Have you noticed that they've taken out seating in so many Starbucks? I'm trying to sit, drink a coffee, and relax.
It's just not chill. But maybe it will become chiller. Intel is set to extend Wednesday's rally after Bloomberg reported it approached Apple about securing an investment. Hey, Tim, you can do this the easy way or you can do this the hard way, That follows a $5 billion partnership with NVIDIA and, of course, the 10% stake from the U.S. government. Right now, those shares are up 1%, but to me, This is something we can talk just briefly with Alpine Saxon Wood's chief market strategist, Sarah Hunt, about. I feel like if the government is buying these companies, right, and you want to get on the good side of the president in order so that your business goes more smoothly and you don't have regulatory problems down the line, maybe you chip in a little bit, right?
Well, it's an interesting confluence of events, because if the idea is we want strategic items made in the United States, then Intel makes sense in terms of you can actually produce chips here, because one of the biggest concerns about that post the pandemic was a shortage of things and then tensions between China and Taiwan. So
it's a good point, and that's not safe, right? I mean, we need to be able to make chips for national security.
We need that. If it was a different kind of investment, then I think the questions would also be different. So this is one of those things where it's an and, where the government is doing it and it makes sense strategically for companies that are here to be doing it as well. Is that the case in all industries? That's a different question, and I'm not sure I would answer it that way. But I would make the argument that similar to chips, pharma would make sense to have more stuff produced here, because you don't want to be dependent on other countries for ingredients. There are a lot of things that you could argue we gave away strategically that we want to now pull back. Is that going to work? I don't know. We're in the process of trying to find out.
So, Sarah, is it time to brush out the list of companies, look through each individual one, say maybe who's got a loan from the U.S. government, who looks to be crucial for security, and just start buying up those companies, assuming the government's going to buy a stake in them?
Well, interestingly, even the defense companies have rallied, but there was a period of time where the defense companies, where you would argue we're still going to need a lot of defense, were looked at as we don't really want to own these right now. So I think that there is a yes to that, but there is a fashion that goes through, a momentum and a fashion that goes through investing themes, and whether or not those themes can stay forever is really the question. And I think you're getting a look at that now, because some of the quantum computing, to your point earlier, is one of those areas where the valuations aren't really there, but the theme is driving them so strongly. So I think that there is a point to that, but it doesn't always guarantee the things.
What's your take on the Fed? It's such an interesting, we all love the kind of macro chat here, but it's such an interesting day to watch Stephen Miran do the rounds on cable news and say, like, the economy's in a difficult position. Everything's slowing down. Rates are excessively restrictive, right? And then you see GDP come out at 3.8%.
So I think that there are a couple of different factors going on there as well. The first one is we still don't really understand the pull through, how strong that's been, whether or not that's going to come to be a problem. I think
tariffs.
Right. So I think that the idea that we are going to need some stimulus may be coming from the idea that the tariffs are finally going to hit, things are going to slow down. I don't know the answer to that. The employment numbers, I mean, this is one of those instances where the futures changed very rapidly, because now good news is bad news, because it means the Fed doesn't necessarily have to cut, and bad news has been bad news, bad news has been good news. So we're back in that area where it's all about monetary policy. But the question really is, does monetary policy, can it fix the things that we think are going to be the problem? And I'm not sure the answer to that is yes, but that's the argument that you're going to have, because that's the argument that you can have.
Right. By the way, Myron's argument isn't necessarily that the economy is really bad. It's just that it could get really bad because we're too restrictive. So maybe he would look at today's data
because we're too restrictive, and because we're putting massive tariffs on all of these companies, right?
Well, and because of immigration, he thinks so too. But Sarah, this underscores the point, is that there's a lot unknown.
Hang on, so Myron's saying the economy could get really bad because we're doing mass deportations and we're putting massive tariffs on our trading partners.
No,
so let's use the Fed as a tool to make this policy a little bit more digestible.
His argument is that less immigration and tariffs, all else equal, lowers the neutral rate. And the neutral rate is much lower than where the Fed is. Not that the economy is bad, but just that the neutral rate is lower. But Sarah, I mean, this is a concept that people really struggle to understand what the neutral rate actually is. Could we be in an environment where next year the Fed is making policy over something that's really squishy and difficult to understand, and maybe gets over their skis in rate cuts to get to this philosophical level that, again, we don't know what it is?
I think that the inflation data is going to be the guide on that, because I think that it is harder and harder to make that argument if you see inflation going in the wrong direction. If inflation is quiescent or stays less problematic, that's going to be the debate. If inflation picks its head up, that debate is going off the table, and the debate that you're going to have is, it doesn't matter right now what the neutral rate is. Inflation is so bad that we have to do something about it. And if the labor market is where it is right now, it's looking not nearly as scary as people keep thinking it was. And this is very similar to the scare that we had last year, where the numbers were really bad in August. September created a big 50 basis point change. And then this year it was sort of like, well, we don't know, but we should do something. And you could argue that the Fed funds rate was a little on the elevated side. Now it's a different it's going to be a different debate each time, depending on where the data shakes out.
By the way, to their credit, at least so far, tariffs don't seem to have destroyed the economy, and inflation hasn't really picked up. I mean, I know the Fed says 2%, but we all know they don't mean that, right? 3% is really where they feel comfortable. If we stay here, is it a surprise to you that we've done so well keeping inflation in check and, continuing to grow with these massive tariffs?
So this is the big question about what tariff rates are actually hitting whom at what time. How much pull forward is there? Is that one of the reasons that GDP is up so much, because people pulled forward? What was the import? What does it look like? It changed in July, but you had a massive move higher in June because people were bringing goods in. When does that run out? And I would argue that if you can keep moving the tariff rates around like we have been doing, you pull forward and it continues to look good, and then people say the economy is really great. Is there a point where it falls off a cliff? I don't know. Does it slow down a lot? Do people just go, here's to CarMax's point, right? Like I bought a new car because I was afraid it was going to cost too much, and now I didn't buy a used car, but now I have a car. So to what level are we front running our own economic activity?
By the way, does the equity market keep trading higher if we keep getting good news, or do we get more days like today if that happens?
I think that if you keep getting good news on the hard data front, like GDP and sales, yes, because that's earnings, right? It's all about earnings, and it's all about that change in direction. If that direction looks higher, the market keeps going. If that direction starts to wobble, the market starts to wobble. And if people start baking in, third quarter numbers are going to be really important. The commentary is going to be important, because that's going to be where the rubber may be hitting the road on tariffs and or what's going to happen in the next couple of quarters. I don't think you're going to get a lot of forward guidance in the third quarter, but people are going to be parsing through what companies say, because it's all going to be about margins, because margins lead to earnings. And if earnings come down, we have a problem.
Sarah, this has been so excellent. A masterclass. Sarah Hunt, Alpine Saxon Woods Chief Market Strategist. Please come join us again soon. All right, let's get a check on your equity market this morning. About 10 minutes into your trade, we're lower by 0.7%. What is leading us there? Let's go straight to the decliner column. It is Nvidia, Broadcom, Tesla, Oracle. It is all the very highly valued stocks. So there are a little bit of jitters in this market. Oracle down after a downgrade this morning. Actually, was Redburn initiating coverage saying that they are trading on headlines, not fundamentals. When it comes to the price action for the individual sectors, by the way, IBM, that one's gaining off that HSBC thing. Energy at the top, as oil has been continuing to gain. At the bottom, communications, infotech. So, Matt, it seems to be a market where the most expensive things are the ones leading the declines this morning. Yeah, very interesting stuff. I'm a little bit distracted because I just keep thinking about Formula One, and I know we need to stay focused. I'm excited about that too, Matt. It's on markets, and we just opened up, so we are continuing to watch these markets. The S&P 500 down 0.8%. Coming up, Oracle under pressure after it gets a rare sell rating on Wall Street, but they were successful in selling like $1 gazillion worth of bonds. So we'll talk about that, and Zak Brown is going to join us after top calls. This is Bloomberg Open Interest. Let's get you some top calls. Some of the analyst action that we are watching this morning. First up, Oracle gets initiated with a rare sell rating. That's at Rothschild and Redburn. The firm is warning that the cloud boom, that is just overstated. Its price target is $175. That would imply a 43% decrease from the last close. Shares down nearly 6%. Next up, Lululemon. That gets downgraded at Needham because the competitive environment is too challenging. Needham recommends moving to the sidelines until Lululemon can, quote, right the ship. Those shares down almost 3%. Meanwhile, Wendy's, that gets downgraded at North Coast Research. The analysts say the fast food chain lacks leadership, market direction, and momentum, and warns that 100 stores could be at risk. Matt, those shares down 1.5%. It's delicious. It's delicious. My favorite store was closed on Broad Street in Columbus, Ohio. I honestly can't remember the last time I've had Wendy's, so I can't participate in this. Yeah, well, I grew up in Columbus, so it's an important restaurant there. Coming up, speaking of important, investors pile into F1 as the popularity of the sport continues to speed ahead. We'll talk with Zak Brown, McLaren Racing CEO, next. This is Bloomberg Open Interest.
The team currently at the top of the F1 championship standings is winning in more ways than one. McLaren Racing was valued this month at over $4.1 billion in a stake sale, the valuation underscoring the increased investor interest in a growing sport. Joining us now is Zak Brown, McLaren Racing CEO. He's also the author of the upcoming book, 7/10 of a Second, which will hit shelves later this year. Dani is very excited to read this book. I mean, I want to read it too, but she's the bigger F1 fan.
I will be the first buyer.
Well,
of
I
this
hope
book.
you enjoy it.
Thank you.
I hope you
Zak.
enjoy it.
Tell us first about the valuations. And did that stake sale go through? Is that
We're all done. We're all done and dusted.
So, man, these valuations continue to just fly. I mean, that's double what it was last time I spoke with you.
The sport is on fire.
Yeah.
You know, every metric, demand for teams. You know, it wasn't long ago before Liberty acquired the sport and put a cost cap in place, which kind of ensured everyone's financial stability and on-track stability and competitiveness. So it's been a wonderful thing. The fans are coming out in the tens and hundreds of millions. Sponsors, partners in the sport, unlike we've ever seen before. So the sport is on fire, and long may it continue.
There's always calls out there when sport valuations pick up that it's a bubble. Red Burns and the Milan owner, for example, has been calling out sports valuations are in a bubble. How do you think about it? Because you are at the top of your game right now. You are in serious race to have both the constructors and championship victory, but also you're going to get regulation changes coming in next year. So have we kind of hit a ceiling in how high valuations can go?
I don't think so. I think if you look at sports in general, and I wouldn't say I'm an expert at all sports by any means, but they've only been going north forever. And, you know, every time there's a kind of record deal in whatever sport it is, everyone goes, oh, that was crazy. And then you look back and in 5 years, they've still gone up. So I think our sport in particular has a lot of room for growth. We have 24 races. We have demand for probably 30 Grand Prix. So the demand is strong. Our car is, has the best brands in the world, the MasterCards, the Googles, et cetera. The competition is amazing. Last year, 4 teams won, 7 different drivers won multiple races. It's the first time I've seen that in my 30 years of following the sport. So the on-track competition is great. The off-track drama, as captured by Netflix, is fantastic. The demand for Grand Prix has never been stronger. So I think the sport, in many ways, is just getting going.
You have also, I think, 53, or last I checked earlier this year, 53 commercial partners, and you've generated the most revenue of any team in F1 history. How do you go about that? Since you're so focused on cars and racing, and you're dealing with Norris and Piastri, and you're focused on aero, like how do you take off the sports hat and put on the business hat?
Well, fortunately, we're a big organization, and Andrea Stella has done a wonderful job running our racing team. So he focuses on the on-track performance, and I focus on running the business. And of course, we're about 1,400 people inside McLaren, so it's definitely not the two of us. We just have our leadership roles, and we're very focused on our partners. We're very focused on our fans, because you need to have every part of your racing team, not just the technical side, operating as we call world championship material. So whether it's your CFO around your cost cap, or your head of HR around culture, which is what's made our team so strong, our commercial team, everything has to be firing on all cylinders. Sorry to use the pun.
Yeah, I wish there were more cylinders.
Maybe the regulations in 2026 will get there. But Zak, I mean, this is kind of where like the drama bleeds into the sport and the business of the sport, right? Especially with a more diverse viewership coming in. I know you've been very open in saying Christian Horner leaving F1 is good for the sport, or at least it's in a healthier place. There have been rumors that he's going to be able to come back now and maybe will next year. What do you make of that for the sport if he does come back?
I mean, he's had a stellar career in Formula One. His results are lots of driver championships, world championships. So I think when you get into sport, not everyone's best friends. There's different characters. So while we may not have too many cups of tea in England, as we say, you know, you need all different types of characters in the sport. And I think that's what makes the sport very exciting. You know, that's that kind of Netflix effect is what happens off the track. And I think our sport's unique in that not only is the competition on the field of play extremely exciting, there's a lot of competition off the field of play. And it's a small group of, team bosses and drivers. So I think the fans can kind of get to know us all. And so I've got my friends in pit lane and some that aren't. But I think that's what makes it exciting, and it's authentic and genuine.
It's very fun. I will say that we now have Gunther Steiner in MotoGP. So my family, we watch the motorcycles, and it's awesome to see Gunther come over from Haas.
He's a great personality.
He's
definitely a character.
He's so much fun, and that makes it all the more fun to follow. Like, we've been able to get into that because of the Netflix documentary. Do you think, on balance, is that only good for F1?
It's only good. If we look at what Formula One, where we needed to continue to grow the sport, kind of pre-Netflix, pre-Liberty, it was North America, right? The sport's huge everywhere, but North America, we had one race, and it was kind of a second-tier sport. Now we have 3 races, and it is a major sport in North America. Tick. Youth, because that's all of our future, and we've brought in a lot of youth, and then women in diversity. So the sport over the last 5-6 years under Liberty's ownership has really modernized and become a very inclusive sport versus what was a very exclusive sport. And you saw it took a little bit of change when Netflix came out. 2 teams didn't participate because it wasn't we're not going to open our doors. And then when we did, and you saw the fandom that came and the exposure it brought for our sponsors, I think they went, I think we need to be in this next time. And so it's been wonderful. And I think the sport now recognizes that without taking care of our fans, we don't have a sport. And I very much believe sport is entertainment. Anytime you're buying a ticket, whether it's for a movie, a sporting event, a rock concert, that's entertainment. So we need to put on a good show for our fans.
But it's beyond athletics, right? I mean, because now Lando and Oscar and you, and you've got to deal with this intrusion into almost into your personal life as well.
Yeah, but you know what? We're in the public spotlight, and that's how our sport works. So if you're not comfortable with that, maybe you should pick a different job. And so I remember my first ever Grand Prix, 1981 Long Beach Grand Prix. I met my first Formula One driver. I saw the cars and the impression it left on me. So at McLaren, there's not a photo or an autograph that we don't stop for, whether it's a driver or myself or Andrea, because you want to leave that lasting impression that I have from 1981 I remember it like it was yesterday. And we've all met athletes over the years that you were a bit disappointed once you met them. And so therefore,
don't meet your heroes.
It was a St. Louis Cardinal. I'm a Cardinals guy. But being good 95% of the time isn't enough, because those 5%, it's kind of a heartbreaker. So, you got to be on your A game all the time. And whether it's a restaurant, you can't control when people see you and they want to talk to you. They're excited. They want to learn about the sport. And so I enjoy it.
So you still like going out to restaurants?
100%.
Okay.
100%.
Zach, we can't let you go with just asking about the rest of the season, because you've essentially got the Constructors' Championship essentially wrapped up. How much of your attention now is shifting to the drivers? And how much of a threat do you think someone like Verstappen could come up and really threaten, be it Lando or
a disruptor?
Oscars? A disruptor, yes.
I think you got to pay attention to Max. We got to keep doing what we're doing. The Constructors is looking very good. We had a chance to wrap it up in Baku, but let's not talk about Baku. Hopefully we can get the job done in Singapore. And what we want to do is we want our 2 drivers and Max, but we'd like to kind of get him out of there, to fight for the championship and just give them equal opportunity, equal equipment, which is what we're doing, and kind of may the best man win. That's what we want to do. We'd like to not play a role if at all possible, but you get into, Lando had a mechanical and things can happen and safety cars and things of that nature. But I think our goal is to just set Lando and Oscar up to be competing for the championship down to Abu Dhabi, and may the best driver win.
All right, well, that is an excellent way to put it, and great place to end it. Zach, thanks so much for joining us. Zak Brown, they're the CEO of McLaren Racing. Coming up in the next hour, Morgan Stanley's Katerina Simonetti joins us on the FOMO that's emboldened retail traders, and the CEO of Nutrabolt, the company behind C4, plus the Prime Minister of Holland. This is Bloomberg. We are 30 seconds into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, with equities looking to book a third consecutive day of declines after very strong economic data and higher yields.
Coming up, Fed Governor Stephen Miran sounds the alarm on U.S. vulnerability, but fresh data points to pretty resilient economic growth.
And a bid for a comeback Intel seeks an investment from Apple as the two discuss how to work more closely together.
And HSBC claims a quantum computing breakthrough as the race intensifies on Wall Street to embed the cutting-edge technology in daily operations. Let's kick off, though, with the view from Fed Governor Stephen Miran. He says the Fed risks damage to the economy by not moving rapidly to cut rates.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Joining us now is Katerina Simonetti, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. Katerina, it was a strong spat of data we got after Miran spoke to Bloomberg, be it GDP, with a lot of consumer spending fueling that, or jobless claims, or durable goods. And it's an equity market that sold off. So is good news bad news now?
Well, Fed is definitely in a position to be tremendously hopeful to the economy. And as we know, the lower rates are beneficial for business. They're beneficial for the consumers and expand their ability to buy and own homes. We know the strength of the economic drive that this policy presents. And we absolutely feel that Fed has been a little behind the curve, with being proactive in cutting rates. We expect at least 2 more rate cuts this year in October and December, and at least 3 in 26 in January, April, and June, I believe. So this is a very impactful policy. And yes, it is much needed considering the data that we're seeing coming from the labor market.
So what data worries you the most? Because I see pretty low unemployment and strong growth, right? We just had today this jobless claims number that was below all of the estimates in the Bloomberg survey at 218,000.
And Matt, absolutely, you're right in looking at it this way. We're trying to do the forward thinking here, specifically with the Dodge policy and how many unemployment claims have not been filed yet. And if we incorporate that into our equation, then the data could be significantly different in November. But we have this data and Fed has it. So it is my assumption that they're looking at it, from the perspective of what are we expecting, from the data and concerns they have over economy, trying to stimulate, trying to make sure that the stimulus that takes some time to work itself through the economy is there when we need it.
Even so, Katerina, with these big question marks, volatility has been sapped from this market and every market, be it equity, FX, and bonds. Are we whistling past the graveyard? Is this market appropriately hedged and appropriately priced for some of those unknowns that you were just talking about?
Dani, it's a wonderful question, especially for investors that are fearing that they have missed this robust bull market or are in position to enter the market now and are worried about the timing. And our view is actually that the timing, even though it's a little bit concerning because we are seeing how overbought this market is, but we see a lot of further expansion that this market is going to bring. And I'm going to start with bonds. I've been advising clients for 25 years, and even though Fed already started cutting rates are still high, and investors still have an opportunity to buy some of the individual municipal bonds, investment-grade corporate bonds, and lock in historically high interest rates to have them in their portfolio. And from the equity perspective, of course, we can't discount the disruptive effect of the AI expansion that we are seeing all over the globe, and specifically in this country, and the opportunities that it can bring, all over the sectors and just for equities in general.
What do you expect from corporate earnings, Katerina? Because we've had double-digit growth, and I know Q3 is forecast at a little bit less than 10%, maybe 7 or 8 instead, but it seems that we every season beat that and rise past it.
Matt, we are expecting earnings to continue to be positive. Our expectation for S&P is 7,200 by mid next year. And again, here is where we need to be really selective and look at each industry specifically, look at the cash flow, look at competitive positioning, and at the overall valuations. There are absolutely buying opportunities in this market. And, as we look at, this seasonality, at historical seasonality and market behavior, usually there is some type of a, pullback or a technical correction during the months of September and October. And given where this market is right now, we expect that market might pull back, and we absolutely are going to be buyers on these dips.
All right, Katerina, great having you on the program. Thanks so much for joining us. Katerina Simonetti there of Morgan Stanley, talking about a $7,200 price target, buying these dips, continuing to buy these dips. Let's get a check on what's going on in the markets right now. Maybe today's a dip for you. We're off about 0.6% on the S&P 500, still at 65.96, which is a relatively high level. The NASDAQ down more about 0.9%, and the 10-year yield, this is one of the reasons for the pullback, going back up towards 420 after last week dipping below 4%. Very briefly.
Yeah. Well, this is the thing, is that the bond market has kind of been showing a rotation that equity markets haven't been reflecting until now, until we finally started to get declines as yields move higher.
Let's get a look at some of the single stocks moving at this hour. Starbucks, we were talking about at the top of the hour, restructuring. It's going to eliminate 900 jobs, cut about 1% of stores globally, and that will save the company, or I should say, result in a $1 billion charge. But obviously, they're trying to save a little money here and really restructure what the stores look like.
Yeah, they need to change. They've already changed the menus. Producer Will pointed out that I forgot that they started selling protein cold foam lattes, which sounds scary. It sounds like a science experiment.
I'm not a coffee drinker, but yeah, I would try that. I would try that. I just want to try it to see what the hype is all about.
Maybe, I don't know. It sounds scary to me. I don't need all that stuff in my coffee. Elsewhere, though, Accenture said that it expects growth to slow next year. They cited U.S. federal spending cuts. The disappointing outlook comes even after the consultancy and outsourcing company beat fourth quarter revenue expectations. Maybe add to that with the White House telling agencies to get ready to make cuts if there is indeed a government shutdown.
Yeah, that's going to be rough, and Accenture has had a very difficult year. Year to date, down 32%. Intel shares, on the other hand, are on the rise after Bloomberg reported that the company approached Apple about securing an investment. That follows a $5 billion partnership with NVIDIA and a 10% stake from the U.S. government. The shares trading now up another 5.5% to almost $33 a share.
Okay, well, coming up, we're going to talk more about Intel and more about the government's involvement in companies along the likes of Lithium Americas with Scott Lincicome of the Cato Institute. That's coming up next. You're watching Bloomberg Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. The private equity giant Sixth Street and billionaire Dean Metropoulos are reportedly buying an 8% stake in the Patriots with a valuation of more than $9 billion. This, according to Sportico. The deal underscores the surging demand for pro football assets and really sports assets in general, putting the six-time Super Bowl champions among the world's most valuable sports teams. We'll have more details for you later this hour. I'm proud to have seen live the Giants beat the Patriots at the Super Bowl in Indianapolis. Denmark is probing Russian involvement after a second major drone incident this week, shut airports and air bases, briefly grounding flights in Copenhagen. The defense minister called the attacks systematic and says NATO allies may be brought in. Police raised the threat level nationwide, warning more incidents could follow. The strikes come just days before European leaders gather there in Copenhagen, or I believe Copenhagen is how they say it there, heightening tensions across the region. Copenhagen is so delicious. The German car supplier Bosch will cut about 13,000 more jobs at its auto parts division by 2030, mostly in Germany. The supplier says its mobility unit faces a nearly $3 billion annual shortfall as tariffs, high costs, and Chinese competition squeeze margins. The move underscores the strain on Germany's car industry, with automakers from Volkswagen to Porsche also trimming staff and output. And Bosch also makes the IMU in my Ducati motorcycle. Let's turn to the Intel and Lithium Americas stories. Intel shares have risen by about 50% since CEO Lip Bhutan visited the White House, followed by the government announcing it took a 10% equity stake for nearly $9 billion. Lithium Americas has also skyrocketed since reports a couple of days ago that the government is exploring a takeover stake. Scott Lincicome called the government's stake in Intel antithetical to American greatness. He joins us now. He's Vice President for General Economics and Trade at the Cato Institute. And Scott, I can understand why a libertarian thinker wouldn't want the government involved in business. It makes no sense from that perspective at all. But don't you think if it's an issue of national defense that we need to somehow support the chip industry here at home?
Well, there is an argument for supporting the chip industry here at home. There's no good argument for the United States government taking a stake in Intel. There are all sorts of ways that the government can help foster and onshore manufacturing of critical industries. But when the government starts putting its thumb on the scale, when it starts having a stake in private industry, when it starts muscling out private shareholders or distorting capital flows, that creates tons of problems, and it could actually undermine the companies that the government's actually trying to help.
What sort of incentives does it create? And Scott, I ask this because of the Bloomberg excellent reporting that Intel approached Apple about getting an investment from them. Would you see something like that of Apple giving Intel money if it were not for the government involvement?
Right, and that's a huge question mark. Is Apple investing in Intel? Is NVIDIA last week investing in Intel because Intel actually makes good products, or because Apple and NVIDIA are trying to curry favor with the government? That might be good for Intel in the short term, but if Apple and NVIDIA are getting inferior products, or again, if capital is flowing away from better producers in Intel's space, then you actually, in the long term, end up with a weaker U.S. tech sector. You also have huge question marks about whether Intel's decisions are being made for commercial reasons or for political reasons. You know, jobs. There's this Ohio facility that Intel is building for semiconductor production. Are those things really good for the company, or are they good for the government?
Scott, I mean, in general, from a conservative, free market, libertarian point of view, you must take issue with so many things in the modern Republican Party. It's just a very different economic experiment than the one we witnessed under Ronald Reagan just 35 years ago.
Yeah, you don't even have to go that far. Really, it's in just the last decade you've seen a dramatic shift in the economics of the Republican Party, and that's very much owed to President Trump, who likes tariffs, who likes making these deals, who has no problem with industrial policy and subsidies and the rest if he thinks that it's in his interest, in the government's interest, and the rest. And that has caused, an identity crisis, I think, in the Republican Party, because you still hear a lot of this free market rhetoric. They're going after socialism and the rest, and then you turn around and you see the Trump administration investing government money, not just in one company, but in several companies, and also taking a golden share in U.S. Steel and affecting its business operations as well. This is not, it's not only not your grandfather's Republican Party, it's not even your uncle's Republican Party.
I'm just curious who is subscribing to Cato Institute research now that Republicans are protectionists and believe in central planning and champion federal government over states' rights. Who are you for? Are Democrats coming to you?
Well, the one of the silver linings of this is that you have actually seen a bit of a reconsideration in the Democratic Party of broad-based tariffs and industrial policy and the rest. Now, I don't think it's a full conversion or anything, but there has been a change, and that's valuable. But look, we at Cato are going to continue to do the research. We're going to continue to hold to our principles, regardless of what either party does. And quite frankly, I'm pretty confident that economic gravity still exists, that tariffs and subsidies and government ownership of private enterprise are not, in the long term, good for the United States and even good for some of the very companies the government's trying to support.
Can I ask you about that big picture, Scott? Because a lot of the projects that these companies are trying to undertake with the encouragement and sometimes investment from the U.S. government take longer than 4 years, will extend beyond President Trump's term in office. How much do you think that this American economy will be remade when we look back at the second term of Donald Trump?
Yeah, it's a huge question mark for two big reasons. First, a lot of the Trump administration policies we're talking about, especially tariffs, have been implemented unilaterally, meaning just by the president. So you could get another president in the Oval Office in a few years that could shut these things down. But the other reality is that because we are such a 50-50 nation, because Democrats and Republicans disagree on so much, industrial policy that's even implemented via legislation can change. I mean, if you look at all of the renewable energy subsidies in the Inflation Reduction Act, well, we thought those might be pretty durable because they were hardwired into law. And then the Republican Party took over and they rolled back a lot of those in the One Big Beautiful Bill Act. President Trump is doing other things to shut down a lot of those renewables. So this is a big problem with American industrial policy generally. It depends on a stable political coalition that we just don't have right now.
Yeah, a lot of unknowns. Scott, thank you so much for joining us. That is Scott Lincicome of the Cato Institute. Still ahead, a quantum computing breakthrough. We're going to discuss how HSBC is using IBM's technology. That's coming up next. You're watching Bloomberg. HSBC said it's achieved a breakthrough in deploying quantum computing in financial markets. The bank used IBM's most advanced Heron quantum processor to attain a 34% improvement in predicting how likely a bond will trade at a given price. Anurag Rana, Bloomberg Intelligence senior tech analyst, joins us now. Anurag, just how big of a breakthrough is this actually for both HSBC and IBM?
I think it's the first practical example that everybody's talking about. So I think it's going to put some pressure on some of the other tech firms to, stop talking about concepts and technology breakthroughs and show some real life examples. Now, again, when you look at the paper that was published, it talks about the use of quantum chip as well as normal computation. So, I'm not so sure how much, if it's 100% quantum or is there a mix of 2 or 3 systems. But either way, the productivity benefits are huge, and it is going to lead to a lot more, emphasis on quantum breakthroughs over the next, 12 months.
Why is, I've read now that the repeatability of this experiment is in question, or the consistency. If they've done it once, doesn't that mean they can do it on a regular basis?
I think the biggest issue with anything quantum is the instability of the actual process and how it can be repeatable, which is what everybody's trying to find out, whether you can run some of these experiments on, normal temperature, normal, you don't have to go to fusion all the time. So I think there is a lot more that needs to be explained as to what are the tech parameters under which this was conducted. But having said that, if they have published a paper, we should respect it and basically say that, okay, there is a big productivity benefit here, and see how the other companies are going to, counter this argument.
Anurag, I know you cover tech and not banking, but do you figure that a lot of corporations out there in finance, be it elsewhere, are also trying to crack this nut? Or do you think people will see this and then an arms race gets underway?
No, JP Morgan has invested quite a bit in it. This is not just something that is, applicable to one or the other bank, but everybody is going to use it. And for the tech providers, whether it's IBM or Microsoft or AWS or Google, what they want to tell everybody is, come to our cloud and basically rent this on an on-demand basis, because they are the ones that are going to provide you with the technology, and you can use your use cases on top of that, or build your use cases on top of that.
You know, there was a time when NVIDIA was saying, or Jensen Huang was saying, this is still 15 years off. And I know that he later went back and changed that statement and said maybe it'll be sooner. But are we talking now about 15 months, Anurag?
I don't know if it's 15 months, but it's definitely not 10 years away. There is so much investment going on. I mean, Chicago has become a very big hub in quantum right now. We recently talked to a couple of private companies in this area, and there are a lot of promising work that's happening. The question is, who's going to go out and be able to monetize it or capitalize it in their own, labs, and then go out and make money out of it. And I think, bigger cloud providers, we think, have an advantage here compared to some of the, I would say, smaller firms.
All right, Anurag, thanks very much for joining us. Anurag Rana of Bloomberg Intelligence talking to us about what looks like an HSBC and IBM breakthrough in quantum computing. It's pretty exciting. It's pretty exciting if they really did nail it.
Yeah, well, I would recommend reading this story because it also talks about other major milestones. Like apparently Alphabet revealed last year that its latest quantum processor completed a task in 5 minutes that current computers would have taken since the entirety of the universe began to try to solve.
Right. It's, I love that idea that supercomputers, right, would take 13 billion years to solve what this quantum computer did in 5 minutes. All right, in terms of markets right now, we are still looking at big red arrows. When we come back, fitness company Nutrabolt surpasses $1 billion in revenue. We'll talk to the CEO next, Doss Cunningham. This is Bloomberg. The fitness company Nutrabolt is growing into a powerhouse. The company behind brands C4, Cellucor, Extend, and its partner brand Bloom Nutrition has eclipsed $1 billion in annual sales. The company's growth follows an overall boom in the industry. Joining us now is Doss Cunningham, the CEO of Nutrabolt. Doss, welcome to Open Interest. Thanks for joining us. This has been incredible growth, not just at your company, but really across the industry in these drinks. And it looked like we'd already gone as far as we could go. How much further do you see this expansion going?
Well, first off, thanks for having me. It's a pleasure to be here today. The industry is growing rapidly. I think it's changing rapidly. There's a lot of opportunity. We have, products that are coming into categories have been here a long time. They're now offering functional benefits, better for you product positioning. So it's just bringing in new cohorts of consumers that, historically wouldn't touch, the energy category or the carbonated soft drink category. But now they find these categories are suitable, for their routine, and they're excited to, take these products. And that's really where we sit as a company, at the intersection of fitness and functional benefits and better for you ingredients.
I mean, count me among them, Doss. I'm someone who literally never drank energy drinks, but has started to recently if I'm feeling tired and want to go play a sport or work out. But how do you think about marketing then? Because I got to say, something like C4, for example, this looks like a hardcore athlete thing, given it's a letter and a number. The can, it is bright yellow and in your face, versus something like a Celsius that kind of looks kinder. It's white, it's got fruit on the label. How do you think about the marketing and who it's appealing to and how to get that wider audience?
Yeah, I think the important thing is we believe it's a multi-brand strategy. The market is continuing to segment. So the C4 brand is positioned to really speak, to the athlete, the fitness enthusiast. It's that active lifestyle brand. Whereas Bloom, on the other hand, this is a brand that is much more adjacent to the wellness space, much more skewing to the female consumer. And I think, for, the energy category as a whole, it's going to be a multi-brand portfolio strategy that wins long term.
How much science do you do? There are chemicals in here that not necessarily bad for you, but I've never heard of because I don't spend much time in the gym. But do you have to have research done at university levels in order to keep up with today's competition?
Absolutely. We've been committed to science for our entire 23-year history. We conduct clinical studies at the University of Auburn. We've conducted studies at Texas A&M University. We also have our internal lab at University of Health and Performance in Arkansas, and we also have one on our campus here today. So clinical research is a critical piece of everything that we do. I think what's important to note here is that our products are tested and certified by NSF. The C4 brand is certified for athletes. So that allows us to really build trust with the athlete community, and it's what's allowed us to work with some of the biggest name brand athletes, such as Saquon Barkley, Bijan Robinson. They trust our products. They know that they're safe and that they're effective, and that's really a huge point of differentiation for Nutrabolt.
Doss, as the company continues to grow at a pretty rapid pace, how do you think about what the future of Nutrabolt looks like? Is it a company you want to continue to have in your hands, maybe IPO at some point, or would you want to look at strategic buyers?
Yeah, great question. I mean, right now, our primary focus is on building our brands and continuing to execute our vision. We just completed a significant investment in Bloom. We're now focused on integration there. I will not deny that being in a public company has a lot of appeal. We've spent the last several years putting in the disciplines to be an effective public company. But right now, that's not our focus. We want to continue to focus on execution, and it's going to be a matter of timing and whatever aligns with our strategy that ultimately helps us make a decision on where to go with the business. But we like that we have a lot of options, and continuing to build the business, I think we'll keep those options open.
Well, how much M&A or how much does M&A play into your strategy then? I mean, are you looking at where you consider acquiring other brands? If a bigger company wanted to buy you, could you see fitting into someone else's portfolio?
Yeah, so first part of that question, I mean, we believe that we are great innovators. We love the option to build brands and build product lines. And, that's always going to be a core part of our growth strategy. But M&A is another great opportunity. We've built a lot of infrastructure here over the last 23 years. And, the opportunity to partner with brands like Bloom, bring them into our infrastructure where there can be real acceleration is a really great way for us to build our portfolio. Right now, as I mentioned, we're focused on the integration. We're focused on, executing our business, but we're opportunistic, and, we will keep our eyes open. If things come up that really kind of meet, our criteria that we think are complementary in our portfolio strategy, we're absolutely going to take a hard look. As far as fitting into another portfolio, I mean, look, we love what we're doing. We think we have a very long runway here, and we've got a strategic partnership with Keurig Dr Pepper, but we love remaining independent and kind of in control of our destiny.
Well, if that eventually ends up in an IPO, Doss, I hope we will be your first port of call. Thank you so much for joining us. Appreciate your time this morning. Doss Cunningham of Nutrabolt. All right, let's get a check on markets this morning. Over an hour into your cash equity trade, and its continued weakness, down by about 0.4 for the S&P, 0.5% for the NASDAQ, with 10-year yields and yields across the curve climbing, coming after that stronger data with both GDP, jobless claims, and durable good orders all looking solid in the earlier hours of this morning. Meaning that good news is bad news yet again for this equity market.
Yeah, it's 3 days in a row of losses here, and I think this sort of started when Powell spoke, and it was interesting 2 days ago. The bond market read his speech as dovish, and the stock market rolled over and fell after his speech, saying maybe we're not going to get the kind of cuts that we were expecting. And now you have today Stephen Miran making the rounds on cable TV, making his case for a lower neutral rate, as you put it, which is the right way to say it, because of the policies that the administration has put into place. But we get this fantastic economic news. In both GDP, it's the third print, but still 0.5% higher than the second print, and jobless claims, which are lower than any of the estimates in the Bloomberg survey. So things look pretty strong, and that doesn't augur well from bigger rate cuts.
Yeah, but it's a weird thing because you could say, okay, yeah, there's strength, so that means earnings are going to be good, so that's a reason to buy. But maybe what the price action today speaks to is just exhaustion. Exhaustion on the economic front, but also exhaustion on AI in this kind of circular economy we've been talking about. So stocks finally feeling the effects of gravity.
Well, and also the idea that inflation is going to be hotter. Central banks are going to let economies run hotter, and that's why you see the long end drifting higher. We see the 10-year yield floating back towards that magic 420 level. Let's get a look at some of the single stocks moving at this hour. Shares of CarMax are falling after the company reported a surprise drop in comparable sales in the second quarter. Consumers apparently rushed to purchase vehicles in the previous quarter to get ahead of tariffs on imported cars. And we also know that CarMax has been losing out in terms of market share to Carvana.
Yeah, already down about, lost about a third of its value so far this year, and that is a painful move this morning. Elsewhere, CoreWeave has expanded its agreements to supply data center capacity to OpenAI by as much as $6.5 billion. That makes the total deal worth more than $22 billion because all companies want to do is spend, and they are getting rewarded for spending.
Speaking of that, Oracle is getting initiated with a rare sell rating at Rothschild and Redburn. The analyst says the market is materially overestimating the value of Oracle's cloud revenue. And by the way, they went out with, I think, an $18 billion debt sale yesterday.
Yeah,
a lot of that 40-year. Who's buying 40-year debt?
A lot of people. There was huge demand, which is also part of the reason why yields went higher, because everyone had to absorb all of that debt coming in and had to sell treasuries to do it.
All right, really interesting stuff. Coming up, the Patriots are selling an 8% stake, making them the NFL's second most valuable team behind our still winless New York Giants. Details next. This is Bloomberg Open Interest.
Some breaking news in the last hour. The New England Patriots selling an 8% stake in a team in a deal that values it at over $9 billion. It is the second richest valuation in NFL history. Zak Brown, McLaren Racing CEO, says the value of sports teams will only go higher.
I think if you look at sports in general, and I wouldn't say I'm an expert at all sports by any means, but they've only been going north forever. And then you look back and in 5 years, they've still gone up.
Joining us for more is Bloomberg sports reporter Randall Williams, and he's right. They only have been going up forever.
Just like stocks.
Just like stocks.
They only go up.
Correct. It's interesting to look at this because you have a billionaire and Sixth Street, a PE shop and credit shop buying a stake. For private equity, that usually likes to take majority stakes of things. They obviously can't do it in the NFL because of regulations. What do they get out of this?
Well, they get an investment that is forever appreciating. That's the bottom line. Sixth Street is the third private equity firm to make an investment at it. This is a 3% stake, so one of the smaller ones that we've seen specifically in the NFL. But nonetheless, this is a $9 billion deal, and I'm sure Robert Kraft and all the parties involved are very excited.
They can't own more than 10%, right? What are the rules that they have to abide by? I think they're not allowed to invest a lot in certain other sports if they already own some.
Well, Sixth Street has a lot of different investments across all of sports. They're invested in the San Antonio Spurs. They bought a piece of the Celtics. They bought a piece of the Giants earlier this year as well.
Real Madrid.
Real Madrid as well.
Barcelona.
With all of these different things, I think that with the NFL, there is a cap on how much you can invest. There's also a minimum requirement for how much you can buy. So I think that what owners are looking at and seeing is that they're trying to provide both on the private equity side and on the individual investor side. They're not the first to do a private equity deal and have individual investors. So I think this is normal. You want to mix things up. You might get some money from private equity and others from individual investors.
The NFL making this rule, opening it up to private equity, again, as Matt was saying, under a 10% stake. Has this been well received by most teams, or most teams either already exercise that option or are looking to sell a stake in the sport?
I think it's been very well received. I mean, this is the fourth private equity deal in a little over a year, and that doesn't even include all of the other deals that have been struck outside of private equity. And I think when they opened up this new pool of capital, what NFL owners are seeing are like, okay, we have this new pool, now we can go back to individual investors and trade off. And so you see some investors who are looking and talking to private equity and then deciding, that's not for me, and then going the individual route as well.
But to be fair, it's not a lot of private equity firms that have taken them up. It's Arctos, it's Sixth Street, it's Ares. The list kind of runs out after that. Why aren't there more involved?
Don't forget Carlyle and Dynasty and Curtis Martin as well. But
still a short list, though.
Short list. I think the NFL is one of the more conservative leagues in terms of the rules that they want. They want to make sure this works first. And what you're seeing is that when you have 4 investments in a little over a year, they're happy with it.
All right, Randall, thanks so much for joining us. Randall Williams there covers the business of sports for us here at Bloomberg. We are just a few moments away from a live interview with the Dutch Prime Minister, Dick Schoof, joining us from the United Nations. So we'll bring you that as soon as we get it. We have markets that are down. This is Bloomberg. All right, a bipartisan group of former Treasury secretaries, Federal Reserve Board chairs, and other economic experts are urging the U.S. Supreme Court not to let Donald Trump fire Governor Lisa Cook. We're talking about Bernanke. We're talking about a number of others here, and we're going to continue to bring you any news that we get on this developing issue, or developing story, I should say. Right now, though, we welcome our Bloomberg TV and radio audiences worldwide to listen to Tyler Kendall's interview.
Thanks so much, and a big welcome to our global Bloomberg television and radio audiences. I'm Tyler Kendall here on the sidelines of the UN General Assembly, and I'm pleased to say I'm joined now by the Dutch Prime Minister Dick Schoof. Mr. Prime Minister, thanks so much for joining Bloomberg. And I want to start by asking you about a topic that's really dominated the conversation here at the UN, the recent violations of NATO airspace.
Yeah.
President Trump says that NATO allies should shoot down Russian aircraft if it happens again. Do you agree with that assessment?
Well, the Russians should be aware that's a possibility. I mean, if they enter NATO airspace, that's a violation. It's a big violation. But of course, we will take care in a way that we think is appropriate, like we did with the drones earlier in Poland.
Well, on those drones, actually, the Netherlands provided the fighter jets, the F-35s. Do you have any plans to provide additional military equipment to our NATO allies, particularly those on the eastern flank?
Yeah, we are also delivering Patriots systems to Poland in the coming weeks. And of course, we are in constant discussions with our NATO allies on how we can protect the eastern border better than due to the Russian aggression war in Ukraine, and the fact that they are entering via Ukraine or Belarus airspace, NATO airspace.
So would the Netherlands be prepared to act if this did happen, if there were an aircraft that violated your airspace?
Well, it begins with the reckless actions of the Russians. And of course, I mean, they take the risk. And of course, it's up to NATO command on how to react, and it's minutes work. The pilots have to decide, they have the command lines within NATO. But Putin should realize that there's always that risk.
And part of this conversation is that the U.S. really wants our allies to tamp down on the imports of Russian energy supplies. And you have a really unique perspective into this because the port of Rotterdam is the largest in Europe. Now, the EU is proposing a full ban on Russian oil to take place earlier than expected, January 1st of 2027. Is this feasible? How would this actually work in practice?
Well, I think it's feasible. And we already brought down oil and gas imports from Russia in Europe by 80%. This was also the chair of the European Commission, Ursula von der Leyen, stating also to President Trump. So we have to deal with the last 20%, but it's mainly Hungary and Slovakia. And I think also President Trump can put a lot of pressure on these countries to stop using oil from Russia.
But then we did hear from the Hungarian foreign minister here at the UN that they don't have plans to actually stop that oil, even if they got a direct call from President Trump. Is there any other mechanism that can be used to really force this drawdown?
Well, make sure that they can get oil somewhere else. I mean, so that's very important because they're highly dependent on Russian oil, but they should stop Russian oil because I think it's right. I mean, when we support Ukraine to fight the Russian aggression war, it's very strange that we finance actually Russia by importing their oil and gas.
And part of this conversation, of course, also has to do with China. And your country is home to one one of the largest chip equipment firms, ASML. China is ASML's largest market. I'm wondering if you've gotten any indication from Washington about the direction of export controls. Is there any indication about perhaps the possibility of relief when it comes to export controls?
Well, we have constant discussions with the Trump administration, and before that on the American administration in general, about exporting to ASML products to China. And we are very keen also from our perspective, because we think economic security and national security goes hand in hand. So we take our own export controls, also relating to China, and we are in constant discussion with the American administration.
So you agree with the White House's national security concerns when it comes to the export of this type of very sophisticated equipment to China?
We see the risk, and that's why we put our own export controls, but it's our own decision that we make, and we want also to make sure that ASML can produce and can deliver, because it's a crown jewel. It's very necessary for the whole chip industry and the developments of AI. So we want ASML to flourish as well.
Well, you said that you're in constant contact with the administration. I'm wondering if you've pressured this White House at all for any sort of exemption when it comes to chip-making equipment once that Section 232 investigation wraps up and likely leads to tariffs down the road.
Well, we had a lot of discussion about the import tariffs. And then we said that from a Dutch perspective, we'd be very keen on some special product, but particularly high-tech and med-tech was very important for us to get some carves out on that. And the Article 232, right, is of course a different issue, because that relates to national security. So that's just a little bit different, and we are in constant discussion.
Okay, but it could perhaps be, a carve-out could be on the table.
Well, I just stick to the word. We are in constant discussion with the American administration on this.
In those discussions, how much pressure is there to invest in the U.S. versus at home?
Well, we invest a lot in the U.S., actually, in general. And I think that we invest, that relates to about 1 million workers in the United States, so that's quite impressive. And we import a lot from the US as well, so there's another balance between the Netherlands and the US than there is probably between Europe and the US, and that gives us a special position.
In the final minute I have with you, Mr. Prime Minister, I'm wondering how concerned you are about Dutch companies and public agencies using American cloud providers. Are you considering any legislation that would require agencies to buy European cloud or tech services?
Well, we think that the European development is very important, because we don't want to be dependent on anybody else, and that not necessarily refer to America, but we want to make sure that the development in Europe is a real European development.
All right, a fascinating conversation will continue to follow. Dutch Prime Minister Dick Schoof, thank you so much for joining Bloomberg. This has been a conversation on the sidelines of the UN General Assembly. I'm Tyler Kendall, and I'll send it back to you.
Tyler, thank you so much for that important conversation. That was, of course, Bloomberg's Tyler Kendall with the Dutch Prime Minister. Let's get a check on markets, though, as we head to the end of the hour, because it looks like we are about to book a third consecutive day of declines. We are down 0.3% for the S&P, for the NASDAQ, about 0.4%. It's because of the stronger data. It was stronger data yesterday when it came to new home sales. Today, it was about jobless claims looking better and GDP looking better, Matt. And the GDP figures was because consumption was so strong. Even though you have Starbucks cutting jobs, CarMax logging much worse sales, it is still a consumer that on a headline level looks incredibly healthy.
Yeah, it's interesting. We had some really conflicting news stories out today because the federal government said get ready for mass firings. You had 900 job cuts at Starbucks, 13,000 at Robert Bosch. And at the same time, we had jobless claims at the lowest level, or lower than our lowest forecast, and another 50 basis points of growth in GDP. Coming up tomorrow, Anastasia Amoroso joins us of Partners Global, and Ethan Devitt of Moneta.